During the Great Depression, the stock market lost almost 90% of its value. Before the Depression, there was little regulation and oversight of the financial markets, and there were few laws in place that regulated financial transactions. After the election of Roosevelt, Congress passed a series of laws that regulated many aspects of the financial markets and energy utilities to protect the economy from another depression. These laws created a fair market for everyone, including making sure that buyers had accurate information about investments, prohibiting conflicts of interest, and regulating utility companies to help keep them solvent as businesses and to keep the power on. Over the years, these laws have been revised to reflect changing times, but the laws enacted between 1933 and 1940 still make up the cornerstone of U.S. securities regulation. There are many good reasons to regulate securities. By requiring banks to keep a certain percentage of cash in reserve, these banks always have cash when their customers need it and are less vulnerable to drops in financial markets. To stabilize the banking industry, the government created the FDIC, which currently gives $250,000 worth of insurance to each person holding an account at a bank. Banks that held consumer accounts like these were prohibited from trading in stocks, which inherently have a great deal of risk associated with them. This allowed consumers to feel confident that their money was safe at a bank, but the government would not be in the business of insuring volatile investments like the stock market through the FDIC. Over the decades, there have been additional regulations enacted to help stabilize an increasingly complex economy. This includes regulations to reduce discriminatory lending practices, restricting adjustable rate mortgages, requiring corporate management to certify the accuracy of financial information, and making sure that outside auditors are truly independent. Some regulations prevent companies from getting too big, so that if they do fail, the economy suffers. There is also an ongoing need to make sure there are strong fraud laws on the books to prevent Ponzi schemes, artificially inflating or depressing stock prices, or novel events like the 2010 flash crash, where the market dropped and regained 1,000 points in a few minutes due to a trader using an algorithm to sell stock. These laws have served us well, but over the last several decades, many laws have been scaled back through deregulation. Since the Great Depression, the largest percentage losses on Wall Street have occurred since deregulation began in 1980. Many economists believe deregulation is the culprit behind several of the most prominent downturns in the U.S. and is contributing to wage inequality. There are certainly good reasons for deregulation in some cases, but regulation of the financial sector is critical to everyone's well-being. The savings and loan crisis of the 1980s, the dot-com crash of 2000, the Enron scandals, and the mortgage crisis of the late 2000s all wiped out a great deal of people's life savings and directly raised the unemployment rate. Many of those people never recovered not just their life savings, but also ever reached the same level of income that they had previously earned. The recessions following many of these events are also taking longer and longer to reach full employment. It's time for the government to strengthen existing regulations and roll back some of the ill-advised deregulation of the last 3 decades.